The UK market has punched above its weight in terms of its share of UK investment funds. So in terms of when you weigh that up against the proportion of the value of global stock markets, then there is, what we call a home bias. There is more money in the UK than you would expect. And so as that drifts away into a more global way of investing, that's naturally going to suck money out of the UK.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Fidelity Investment Director Tom Stevenson to ask why British investors have been shunning their own domestic company shares. What is the right amount to hold in your home market, and could now be the time to get interested in the UK once again? Before all of that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel. Give us a like and leave a comment if you want. And once you've subscribed, remember to hit that bell icon at the top of the page to turn on notifications so that you'll get new content as soon as it is released. That all said, Tom, welcome along. How are you?
I'm good, thanks, Ed.
Now, I've made this claim in my intro there that the UK investors are shunning their own market. What is the evidence for that?
Well, the numbers point that way. Analysis of the inflows and outflows into and out of mutual funds investing in the UK market were negative last year, £11 billion. So quite a substantial amount, and that's not all of it, because that was the 10th year in a row that had happened. Add up all the outflows over that 10-year period, and you get to 71 billion pounds. Yeah. So it's a significant and persistent outflow from the UK market. So yeah, the numbers tell the story.
Yeah. So to be clear, that's a net figure. So 71 billion flowing out of funds that invest in the UK market. That's the important part to say here. Yep. All that, despite last year, at least, a very good year in the UK market, right? Yeah. I mean, and normally it perhaps shouldn't be the case, but it is often the case that retail money, what retail investors do with their money, it kind of chases where the performance is a little bit, doesn't it? And you would have thought that a really great year in the UK market would have prompted inflows in. Maybe it happens on a lag. Who knows what will happen this year?
Yeah, I think that is the key point, that there is always a lag. And if you look at the flows, I mean, I mentioned that 71 billion and 11 of it last year. Actually, the last 3 years have been far and away the worst of those 10 years, and they have actually sort of coincided with a pretty, until last year, pretty indifferent period in the market for UK shares. So we had, if you remember, we had 2022, which was a very bad year for markets globally. Actually, the UK did relatively well. I was going to say it was but relatively well was 1 or 2% on the year, so it was basically flat. 2023 and 2024 were positive years, but pretty unexciting. I think I had a look before we had this conversation. I think it was 4% in 2023 for the FTSE 100. I think it was 6% in 2024. Then, of course, last year we had a really good year. The UK market was up by about 20%, did much better than the US market. It wasn't the best performing market last year, but it was a very good year for the market. So, given that there is a bit of a lag, and that retail investors in particular tend to chase what has been performing in the recent past, it's entirely possible that 2026 turns out to be a better year for UK funds, but we haven't got there yet.
Yeah, and when you lay out there some of the kind of shorter term factors, basically performance factors that are going to kind of catch the eye of investors. A few other short term ones. I mean, obviously there's other places in the world that people can invest, and lots of attention on places like the US and the sort of runaway success of many of those huge companies in the United States. That's bound to have taken some of the attention off the UK.
Certainly in those 2 years, that 23 and 24 were really strong years in the US market, and that's where all the attention was.
Yeah, but are there some longer term factors going on as well, Tom? Because as you say, it's not just the past few years. It feels maybe a bit more structural than that.
Yeah, I think it is. I think there are I think there are two or three factors at play here. One is, you talked about other markets. There is definitely a trend towards globalization of investment flows. So investors are less interested in investing in their domestic market, and they're investing more on a global scale. So I think that's one of the reasons. That's one thing that has sucked money out of the UK market. And you also have to think about the starting point there. That the UK market has really punched above its weight in terms of its share of UK investment funds. So in terms of when you weigh that up against the proportion of the value of global stock markets, then there is what we call a home bias. There is more money in the UK than you would expect, and so as that drifts away into a more global way of investing, that's naturally going to suck money out of the UK. So I think that's one factor. I think another factor is the shift from active to passive. So these numbers that we're talking about are really they're mutual funds. In the main, they're actively managed funds, and a lot of the money is going passive. So it's being invested in tracker funds that simply try to mimic the performance of the index. And the numbers that we're talking about, over the years are very substantial. So it's a big drain on the money that's has been sitting in active funds and is moving into passive funds. So I think that's another key factor which is driving this.
Yeah, I remember at the start of my career writing about investments 15, 20 years ago, home bias, the issue of, you've outlined it there, of people having too much money, too much exposure to their own domestic market was a constant thing, a warning to investors all the time that they should avoid this if they can. And I think it has to be something to do with passive investing, doesn't it? The fact that people are choosing options where the UK allocation might be down at 4%, and that's probably half where it was a few years back. It's sort of, that's bound to lead to a kind of drain of money out of the UK, right?
Yes, and there's a good argument why you should not be heavily exposed to the UK market. I mean, the UK represents only about 4 or 5% of the value of total stock market. So to have in excess of, let's say, 10% would seem to be a fairly big bet on the UK market. And when you look at the relative performance of the UK market in recent years, you can see why people would not want to do that, because the UK over the last 10 years or so, 10 years in particularly, the UK has really underperformed, until last year, has underperformed other markets like the US.
Yeah, and I think that underperformance is definitely part of the story as well. I'd be interested I don't have those figures, but I'd be interested to see the figures for, say, the European region or Japan or some of the other major but sort of secondary markets to the US, you could say, to see if they've experienced a similar thing, because it just feels like for such a long time now, the US has been where we've assumed growth is going to come from, innovation in industry is going to come from, and I think actually where returns have come from as well. And so maybe that's part of this picture. Okay then, Tom, so what is the right amount to hold in the UK? If 4% or 5% is too low, if more than 10% is too much, how do you look at that sort of question?
Well, I mean, the number that springs to mind for me is about 10%. It is. I think it's not unreasonable to have an exposure to your domestic market, in as much as it's a market that maybe you understand better. That
was always the case. That was always the argument for it, or the explanation for it, or the excuse for it. It was that it's close, these companies.
I don't think it's a very good reason for doing it, but it's an understandable reason why you would, you'd feel more comfortable having that. I think there are good short-term tactical reasons why you might want to have a bit of an overexposure to the UK at the moment. I mean, the most obvious one is valuation. The UK market remains significantly cheaper than the US market. We're talking about the average share in the UK is trading at about 12 or 13 times its expected earnings compared to, 21 or 22 times in the US. So that is a significant difference. So there's a valuation argument, and that valuation is also reflected in the income that you can earn from UK shares. So the UK has always been a high dividend paying market relative to other markets around the world. You can get a yield of 3.5% or 4% on your UK shares, and that's pretty attractive. And you compound that up over the years, and that becomes, a significant contributor to your overall returns from your investments. So, interest rates are relatively high at the moment and are, showing signs of coming down. We've just had a meeting when they didn't come down, but, they are sort of on their way down. So I think there are plenty of reasons why you might want to have more than that 4 or 5% that otherwise, a properly weighted exposure might suggest.
Yeah, and it's been an argument, and I think there's truth to it, that the UK market, if you look at the level of where the companies earn their money, it is quite a globalized stock market in the first place, isn't it? And so actually, it's not like you're getting you're putting 10% of your money exposed to the UK economy, for example, where people are a bit pessimistic. These are companies making their money all around the world.
Yeah, that's always been the case with the UK. It's a particularly international facing market. It's not unique in that. I mean, if you look at European shares, continental European shares, they also only earn about a third of their revenues in Europe, and a third in the US and a third in Asia. But that's also true of the UK. So it's not a reflection of the UK economy, certainly at the level of the FTSE 100, which is the most international facing part of the UK market. When you come down into the FTSE 250 and the small caps, they are more domestic in nature. But even there, even in the FTSE 250, there's a good exposure to overseas markets.
Yeah. Okay. Well, finally then, Tom, we know that the government is hopeful that it can stimulate greater levels of investment across the UK population as a whole. It's even spoken about incentivising investments in UK companies. Do you think it's actually within the gift of government to stimulate its own market in that way and encourage people to invest? Is it harder to achieve? Is it a more cultural issue? What's your take on those efforts?
Well, I mean, I think the government can try, and I can see why they would want to encourage more investment into the UK market. I mean, having a liquid, healthy stock market is a good way of supporting growth and innovation in the economy more generally. So I can see why the government would want to do that. I'm slightly cautious about efforts to encourage behaviour, to nudge behaviour in a certain way, particularly when it comes to asset allocation, because I think that you should be allocating your assets according to where you think the returns are going to be most attractive, not to suit the purposes of what the government happens to want. So I don't think it would work even if they were to try it. So, I think the government will talk about it, but I think the reality is that this drift from the UK to other markets and towards a global way of investing will continue.
Okay. Well, Tom, we've covered a fair bit there, so we'll leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. Hit that bell icon to get notified as soon as new content is released. Give us a like or share the episodes. It really does help people find what we're doing here. That all said, Tom, thanks for joining me.
Thanks, Ed.